what's happening in the global economy, if we look at, we have been seeing a lot of drastic steps being taken by the US, powered by their president, as far as a tariff goes, which obviously are disruptive in nature. We have seen wars going on in Middle East, in Russia, Ukraine, and other parts of the world, and likewise many other things which are happening. Now, if you see for the last 20 years, this kind of global disruption is very common. Some way or other, it keeps happening. And if we see the investor psychology and sentiments, they always keep worrying about if this thing happen, what will happen next. So those who investors who are into the market or into the investment spectrum for the last 20-25 years, they have seen this upside going up and down and all these cycles, and they have somehow understand that in the long run it doesn't matter. And what exactly we are seeing in India is like that India is slowly getting matured, despite having the India-Pakistan war couple of weeks back. We have this Middle East crisis. Market do not react. The retail investor do not take out money. So that is actually a evolving market example. Now we move ahead with our presentation. Uh, if we talk about the global economy, just a minute, I just okay. So if we talk about the global economy, OECD has lowered 2025 forecast, flag trade tension. I started these sessions with concept of this trade and tariff tension across the globe. So as a result, which is quite evident that they have lowered the growth forecast for 2025. So if you see the diagram out here, you will able to find out the forecast for 2025 GDP and the forecast for 2026 GDP. So most of the countries have a lowered forecasting as far as the projection goes. Global map on inflation versus growth. Now, if you see the couple of pointers here, uh, inflation burst, buy cash in safest currency, sell financial asset, inflation boom, burst, boom, deflationary burst, boom, and then we have put on the countries out here. So we have what we have done out here is that if you see the inflation burst, these are the countries where the inflation burst is there, and these are the countries where deflation burst and the deflation boom is there. Okay, so what does it mean that in deflation boom scenario, buy innovative companies with pricing power and sell companies with little pricing power? So that what we are projecting this thing. Chinese share of export to US, Europe, and Japan declining, which is quite evident as the tariff goes by. And the graph also says, now this is the rest of the world graph, and this is the US, European, and China, share of China to the world. So the share of China to the world, rest of the world is increasing, whereas the US, Europe, and Japan is decreasing. Okay, China unable to shift gear from investments to consumptions. So this is the overall China data. This red line is at the consumptions, and this is blue is a net export, and this is a government expenditure. So if you see the diagram out here, the investments, now the China's investments is unable to shift from the investment to consumptions. Okay, China has a large debt burden. So this data is from 2007 till date. And if you see the number, the China's debt burden, like US, is also increasing. China, India, and US also contributes 50% of the global economic growth. It's quite evident. Okay, so this is the share of global economic growth 2025 and 2030 projected. So this is the China, this is India, this is US, and this is the other countries. Gold has outperformed every other asset class. Now, we have already mentioned that last year gold was the top performer, and this year also. Like India, Russia, and China, they are buying golds like there is no other asset class, the government. And the thing is that like every housewife, whenever they get some money or occasions, they buy gold. Like it seems that the India, Russia, China, and all those countries, they have been buying gold crazily after that, and that is the reason gold price has soared. So if you see the gold vis-a-vis other asset class, this is the gold, data performance, and this is the MSCI World all caps. So this red line is the all equity caps across the world. This is the global index, government bonds, world energy and global government index 1 to 3 year and greater than 10 years. So if you see the all asset class in the last 1.5 years or 1 year or so, gold has clearly outperformed all the asset class. Rates and market have moved in opposite directions. Dow Jones Industrial Index average is YTD return is 3.6%, and if you see the S&P index YTD return is 5.5%. So I have given you the example of industrial. This is the index return. Okay, this is the central bank easing. So if you see the bond yields as well as the sector return, I have given a correlation out there itself. So now bond yields at the start of year 2025 was 5.47%, and bond yields right now is 4.23%. So it has actually reduced. Okay, so that's what we are saying, that the bonds and market are moved in opposite directions. This is US, this is the Europe and other countries, this is the Brazil and Nikkei and emerging market countries which are saying. So mix and all. So here the central bank, what they have done, they have reduced the rates, and here is a increase the rates. So when they have increased the rates, now you see the yield movement. You see the yield movement out there. Moving on. Research on Gavical research on global equity. Now on US, they are very fundamentally positive. Momentum they are neutral. Valuations negative, policy support negative, and position negative. So if you see in India, as well as the renowned firm Gavical Research. Now, the fundamental they are very positive, momentum they are neutral, valuations they're negative, policy support they're positive, and positioning they're positive. Now, what that actually means is that obviously, when you see the India specific data, you will find valuation wise we are costly. But if you see the fundamentals of our Indian companies, we are very strong and very positive about policy support, and positioning is also very positive. So that's what I mean to say. When you see how the US, the fundamental are strong because all the US company fundamental strong, but valuations, policy support, positioning, they're in a negative framework. So that's what is happening across the globe. So in the entire scenario, if you find India's position, they're very attractive. As bearing this valuations perspective, India looks attractive. Now, when I talk about valuations, why Indian stocks predominantly are looking at a higher valuations, because they have gone up very sharply over the last 2 to 3 years. But their underlying top line and bottom line has also increased. Okay, so that is the reason it has gone up this way. Gavical research view on global sector. So if you now they have given a views on the country specific, now given a sector specific. So if you see the sector financials, they are very positive about technology. Well, the valuation is cheaper. Policy support and positioning is also negative. So interesting thing is the last two line. Policy support and positioning. These two will actually decide what the first three line will move across. So if you see financials, industrials, uh, you see real estate, their fundamentals, and these are negative. So the three things you have to check. One is the policy support, positioning, and the fundamentals. Okay, if these things are positive, then there is a huge prospect that the sector will move up. So in that scenario, this is the world scenario. Like you see the financial, you see the industrial, then you see the materials, then these are the sectors which looks very attractive globally. Mind it is not India specific. Growth required credit, but many are over leveraged. Now, if you see the total country's debt, now debt to GDP, see the debt to GDP ratio, government debt to Japan rating is this, but see the debt to GDP 430%. If you see the US 430%, 340%, and China, so all these countries they have a huge total debt to GDP. Vis-a-vis the India is very negligible. Real 10-year yield, you see this is the 10-year yield, real 10-year yield, minus the inflation that they have done out here. So this is the rating out here, and they have given itself. Okay. Interesting data to observe is India's rating. This is triple B negative. Well, we expect this rating to be improved over the years, but it depends upon the global factors for that. But having said that, US with having double A plus rating and 340% total debt to GDP is a big thing. You know, see the term spread out here itself, and same as China also. It use a huge debt up. India is the least debt total GDP. So that's what we talk about global economy. What we have mentioned out here is that China's total supply to the rest of the world is increasing vis-a-vis China's supply to the US, European nations is decreasing. Okay, we have seen the total debt to GDP ratio across the globe, be it Japan, China, US, Canada. They have a huge debt to GDP ratio. Vis-a-vis India is having a very less debt to GDP ratio. Research shows that financials, materials, and communication they have a better advantages globally, and research also shows that India, although valuations looks at very higher up, other factors are well poised, be it policy, be it positioning, and be it fundamentals. So that's what is what exactly happening in the globe. And obviously, this tariff has caused a disruption in the global economy. So the GDP forecast for the 2026 is lowered by most of the rating agencies. So that's what happening in the globally. So we come to the US economy now. US economy shrink in Q1 2025 below market estimates. This is the data from Q1 2022 to till date, which is evident by the policies of the US government are taking. US federal deficit and debt remain elevated despite Trump bringing up this Elon Musk unit, what it was called, uh, government efficiency, and then he removed the Elon Musk. The debt of US has not reduced. It has remained in the same elevated level, and that is one of the reasons why you will find there has been uh, Elon Musk have moved out of the government of this government efficiency unit. That is one of the reasons. There are other political and business angle also, and he questioned about huge spending of Trump policies and likewise. And as a result, this is evident. Now, this data I've been showing you every month for the last 2 to 3 years, 2 to 3 years. And if you see Dodge, okay, if you see these numbers, U.S. national debt and this debt per citizen, it's remained same. If you see my data 2 years back, it is also same. So that's the reason what is happening. U.S. fiscal federal deficit, you see the numbers, they have been keep on increasing over the period of time. Okay, and this is a gradual increase, see the last 3 years kind of thing, and that is the reason you see the US total GDP is getting down. US government paying more than 1 trillion annually in debt servicing costs. So what happened in the last slide I have shown you that debt to GDP ratio of US, Japan, and Canada and other China is high. So when you have a huge debt burden in your hand, suppose say for example you have taken a huge debts. Now what happened is that you incur a too much of interest cost. So in that scenario, it becomes difficult for the country to take more debts because as a result, your interest burden keep on increasing, and then actually impact your fiscal deficit number. So that's why it is keep on increasing. More debts you take, more interest you have to pay, and more fiscal deficit will keep on adding like this. So that's what happening. US government is paying more $1 trillion in debt servicing cost, and it's become difficult for them to raise more debts. And that's the reason I say this data like rating. I have a clear doubts about the rating given by the rating agency globally, but I can't say more about it. This is a global call. This is a global research firm. There are a lot of other political arena also goes behind that aspect also in rating kind of thing. Anyway, moving on. Um, New beautiful bill could add 3.3 trillion to federal debt. Now I've been telling you about US debts and all, and Trump has been saying gaga over the new beautiful bill. Now what is a new beautiful bill? The new beautiful bill is that they have cut. these subsidies on different government spending. Okay, and they have cut. They have actually tax. They have reduced the tax burden and cut the subsidy uh, for uh, for the U.S. citizens. Basically, it's a political move to impress Trump's voter arena, so which actually is impacting, which actually will be impacting U.S. federal government, and that is one of the reason why you have a huge difference of opinion between Dodge team led by Elon Musk and others. Okay, so that's what happened. You see the projected number. This is the Senate version as proposed in June 2027. This is the version passed by the House in May 2022. So this will actually add 3.3 trillion to uh, you know federal debt. So that's is going to be a massacre, huge for the U.S. kind of thing. Decoding US policy in this perspective with such a huge debt, it's like a pole of painting. You can't analyze that. Rising uncertainty weighs on consumer sentiment and corporate outlooks. So consumers are worried about losing their job. These corporate earning expectations are deteriorating. CEO confidence dropped as uncertainty has risen. Consumer sentiment declining across the income group. This is what happening in the US. Stagflation, US FOMC project a core PEC and real GDP for 2025 over term. Headwinds to US economic growth, tariff. Now, what exactly is a headwinds to US economic growth? Tariff, retaliation, uncertainty over trade deals, Iran Israel conflict, lower consumer confidence, lower tourism, negative wealth effect, student loan payment restarting, Dodge laying off government workers. So, these are the some of the factors which are happening in the US economy. US yields are the most attractive in the last 15 years. Now, this is the US 10-year tips yield. So, if you see, this looks more attractive in the last 10 years. So, if you see from 2014, so right now, these yields are elevated right now. So, when the yields are elevated, the rate reduces, it goes inversely. Okay, so that's what is happening in US, but rate has not been able to. Now what is a concern is that the US rate has not decreased. Okay, because of these huge debts kind of thing, and they cannot just reduce because the inflations will also be there, and because of the inflations they cannot reduce their debts, reduce the interest rates. With a higher interest rate and with higher debts accumulating because of the big beautiful bill, only God knows. That's why I'm saying the US policy is very difficult to predict and analyze what's going to happen there. But I just am showing you what the data is saying. Foreigners own a lot of US assets. So if you see the total foreign holding as per instrument, 20% of total equity, that is 18.5 trillion US equity, 30% of total treasury, 7.2 trillion US Treasury, and 30% total corporate credit. So this actually is owned by the total foreigner. So 20% of total US equity, 30% of total treasury, and 30% of corporate credits. Now, who actually owns that data has to be drilled down further, but China has a substantial holding in this. Ratio of MCI emerging market to S&P 500 index lowest since March 99. US effective tariff rate likely to settle in the mid-teen. So that's what happening in US now. I have given a promotional thing before coming into the sessions, like dawn ko samajhna muskil hi nahi, namumkin hai. So that's what exactly I've shown you in the US data, where it is showing as a summary that US debt has not decreased over the period of time, and last 2 to 3 years it's been even same. With the big beautiful bill which Trump has passed right now, it is nothing but reducing subsidies, tax cuts, and all those things to just to impress the voter around across, and to fulfill his election promise, which will actually incur more $3 trillion debt rates added to what exactly is there. Now, US so that's debt burden is higher in US, and if you see the interest rate is out there, it is also elevated. The yields are also elevated with the higher interest rates. With this increasing debt burden, it will be difficult for US to sustain at that level. Now, why? Because of this thing, the US is doing this thing. That's why I'm saying that कौन को समझना मुश्किल नहीं, it's नामुमकिन है. But one thing, despite having said all these things, one thing I always say that U.S. economy has survived and has grown over the years because of innovation. US is leader in innovations. Okay, so when you innovate something in any areas, you became the market leader. A lot of revenues come from there. So in any sector you choose, US being a fundamental innovator in there. So if the US keep on innovating, you know, they will, despite having these debts, I don't think that they will have suffer. They will suffer very deeply. But yes, if the innovation stop, like what they are saying, they are having a closed economy, they are making tariff barriers and all those things. What this impact is going to happen in days to come, that days will tell. But U.S. economy can survive this if they keep on innovating and coming up with the new products which they will circulate across the globe and take the advantage out of it. And with the new tariff coming up, with Trump imposing tariff across the globe, we expect to generate more revenue in that way, kind of thing. So let's see. So that's what is happening in US. Data already shows that things not only looks good, but yes, if they keep on innovating, if they keep on innovating new products, and if they keep on dominating their products across the globe, with the tariffs coming up and across, this somehow they can manage. But geopolitical things are difficult to predict. What this mean by tariffs, as I say, that China's dependency towards Europe and US is reducing, and so their trade across the globe is increasing. I saw you in the first couple of slides. So that will happen with many of the countries. They will move towards other countries than the US. So all this thing, how will shape up, time will only tell. Now let's come to the India. What's happening in Indian economy? Are we the oasis in the deserts? I have been telling this thing for the last so many sessions of mine, monthly sessions. Let's see this month's data also. Headline: India records 13.5 billion current account surplus in March. Current account surplus. So this is the important data. Okay, current account surplus 13.5 billion current account. This is a big number. India GST collection rises 6.2% year on year to 1.85 lakh crore. India gold reserve hits a record high as central bank hedge dollar risk. This is another interesting data. India's gold reserve hit record high as central bank hedge dollar risk. Retail inflation eases to over 6 year low at 2.82% in May. So all these pointers are important when we see the Indian data. And these all pointers will actually reflect in the data which I'm going to show you in the coming subsequent slides. India overtake Japan to become the fourth largest economy. So this is the factor, this is thing. Now here, interesting data point I will tell you. You see the per capita GDP. India's per capita GDP is 2878, whereas in Germany is 55, China is 13,000, and US is 89,000. So this is basically because of the population. Despite India is having the fourth largest economy in the world, like many are feeling proud of it. You know, the interesting data, and despite this number, this per capita GDP, Germany is having 55,000, and India is having only 2,000. Sorry, 2,800. I tell you one interesting data point. You know, the if you talk about the billionaire, the number of billionaires in India is way ahead than Germany. Shocked? Yes, that is true. Because the people who are billionaire in Germany and the people who are billionaire in India, India way above than Germany, which actually tells us that the divide between rich and the poor is very, very sharply increasing in India. Okay, so that is the cause of concern for the government. Not being the fourth largest economy, or maybe overcoming Germany also, will not be a great achievement. But the rich versus poor divide in India is increasing rapidly. So I have a data which I will show you in some other day. You will be able to find out why this thing is happening and how enormous this difference is. So mind it, despite India becoming the fourth largest economy in the world, uh, Germany being the third, India total number of billionaire in Germany versus total number of billionaire in India. India is way ahead in that, with having the per capita GDP much lesser number also. That is the biggest worry for India. The, the gap between rich and the poor is increasing rapidly. Okay, so that should be looked into, not this data in isolation. India has also simultaneously focused on inclusive growth enabler. Uh, India tried to focus on inclusive growth enabler, affordable housing, LPG coverage, domestic PNG, household with solar rooftop, water, electricity, household with sanitation. So that has been keep on increasing over the years, which has been there. India break into global manufacturing top five. So that's the number which we are seeing. The manufacturing of the top five out there. When I say that India has a much bigger, this billionaire than that of Germany. It actually tells us that why the reason is happening. One of the reason I just tell you because it comes to my mind right now is that I see a lot of people. If you see the people in Germany, US, and other countries, most of the people invest in stocks. They invest in market. Their money grows. Whereas in India, we find still with mutual funds, shares, and everything coming up, people do invest in traditional investment asset class. So I find that people in normally 15 years, the market has given 14-15% approx return over the period of time. Now, in a 14-15% return, your money will be doubled in 4 to 5 years, 10 years. Okay, any money you invest. But if you invest in a traditional asset class, whatever small money you have, in at a 7 and 8%, it will take 10 years to get doubled. Okay, so the creating of wealth is also about getting more awareness, getting breaking those safer mentality in mind, or getting those actual consulting, professional consulting, depending, trusting them is also important. So that plays a major role. There are other factors also, political and other factors also, but this is also one of the arena. I find a lot of people, they do invest in traditional asset class and don't take a calculated risk by investing in those equities and other asset classes. So that's why the money, the wealth, whatever is not growing. Yes, whatever the income generating factors, there are a lot of other factors also because of that. This is one of the factors for that. So moving on, India break into global manufacturing top five level. That's I've said. India is fiscally prudent. So if you see this data, core data of non-financial sector. So this is that India's debt has. I've shown you the debt structure of other countries. Now this is the data: household, corporate, government total. Okay, so if you see the government debts, this is India. Okay, so this is the corporate debts. You see the corporate debt. Now that is a very interesting data point. That's where the stock market behaves. Now you see the corporate debts where India is standing is much lesser. This is changed in Q1 2008. That's why I'm saying in Q1 2008 is minus 12%. The corporate debt has radically decreased over the period of time. Okay, and that is the results which you have seen in Indian stock if you have invested, and that is the C. That is the thing which I'm told you just right now. 2008, like 15, 16, 17 years, if you have invested in the corporate, your money has grown 3 times. Vis-a-vis if you have invested in traditional thing, your money has grown only probably doubled. Here it is 3 times it has moved on. With the compounding factor, it increases more. Okay, so that's what is one factor which I telling you how why India is having a billionaire. This thing. There are other factors also. Moving on, market is re-rating India. I told you, rating agencies, they will have to re-rate India because of that. You will see in the days to come it will happen. India tops the emerging market tracker. So if you see the India's corporate index, there are other factors: export, CPI, import power, EMI manufacturing. India is top across all the emerging market, including China also. In highest ever food production in FY 2025. So this is the 2025 food production. So there has been a 6.5% increase. So because of this highest ever food production, you will not see the inflation this time also, which is a good. Okay, and we have seen a very decent rainfall out here. So as we speak, it is raining outside my room also. So we have a very decent rainfall this year. So highest ever food production, decent rainfall, definitely the inflation will be under control. Okay, and I see the lowering of corporate debts over last 16, 17 years is also advantage. Rainfall, as I said, already mentioned, rainfall deviation from normal. So this is the rainfall. You see, this is higher up rainfall. Surplus 9%. All India reservoir level higher than the last year. This is the reservoir level across India, which is higher, obviously because of the rainfall. Kharif showing picks up area. So if you see the Kharif crop situation, year-on-year percentage growth, you see the huge increase over the year-on-year, it's 12%. Capacity utilization level remain robust for manufacturing. Rolling 6 months government capex surged to an all-time high of INR 7 trillion. Listed corporate capex outspaces centers capex. Private capex revival key to boost growth. FDI net investment in FY 2025 declined to 0.4 billion, the lowest in over a decade. Now, this is the one data which is not in favor of India. The FDI net investment in 2025 is declined. Now, despite FDI net investment decline, the market has not reacted to that level. Okay, so this is the data. If you see FDI net investment, so it has gone down in 0.4 billion, not specific to the India region, but specific to the US region kind of thing. So a lot of US investors, they have actually pulled out money uh, because of Trump factor. They say that invest in US, you will have a lower tax, else you will have this and this and this burden. You know what, how the Trump behaves. So not because of India specific reason. Last time he said that the Apple has to manufacture out of India and come back to the US. We'll give this concession, that concession, and then he threatens. Okay, if you do not come, then you will put this much of leverage and tax and all the stuff. So he basically is a bully kind of person, and that's what he is trying to do. But this has not to do with India. This FDI net investment in decline. So we assume that over the period of time it will reverse because market is more important, more aggressive or more mature than any individuals, be it any country's president also. So I hope this will turn around, and this will turn around. Not a hope. You will see in, probably not in next 5 6 months, but over the period of time. GST collection lower in June than estimated nominal GDP growth of 10.1% FYF year. So this is the GST collections. Okay. Uh, Cyclical thing. That's okay. Green shot visible in rural segments. FMCG volume. So I'll just quickly move on. Budget boosting income in the range of 4 to 6%. Benefit of proportion to post-tax income of various to salaried individuals. RBI cutting interest rate. We expect interest on EMIs to come down for consumers. We have seen the rate cuts happening, and I'm expecting with over monsoon, with excess food production, reduce corporate debts, and robust capacity utilization, interest rate, inflation to be under control, and we can see more interest rate going down. Okay, so that will happen. So one rate cut I can expect. I'm expecting this month, this year kind of thing, not this month, this year kind of thing. And when that happens, the EMI and other burden will reduce and it will pass on to the consumer. This will also give boost to the Indian economy more. Oil prices deep ahead of OPEC plus meet as geopolitical tension ease. GST cess, USD 20 billion surplus, another bonanza. So So you have some large item with probability of GST cut, health insurance, two-wheeler, cement, and other significant factors. So this will add on to the another bonanza. Disinvestment proceeds are likely to ramp up in FY 2026. So you have couple of disinvestment plan for the government, IDBI privatizations and other disinvestment plan are there. So this will actually give government more funds. And RBI has been giving a lot of dividend over the years. So last time also they have given. I expect this year the way it is going, they will also come up with a huge dividend in the month of March 2026. So that will add up. So that is the reason we have a current account balance surplus as I start my presentations this time. So that's what happening in India. It looks very, very, very positive kind of thing. With with as I mentioned, the summary kind of thing. We have a robust food production. We have a over have a monsoon sessions. We have a lower corporate debts. We have a robust capacity utilizations. So India market is really looking very good, and we have a current account surplus also. So let's see what exactly that reflects into the Indian equity market. Before starting in the equity market, I will say that because of this factor, we have seen a robust growth of equity market over the last 5 6 months. Now, when there is a robust growth of equity market, now equity market actually moves in a forward. Forward, what happened that if there is a positive news comes up, the market move up. Now, then market waits for the results to be declared in a quarterly and half yearly and annual results. Now, if that result expectation is not matched with the initial euphoria, then the market corrects. That's what happened. So we have seen Indian market moved up a bit, and when the India-Pakistan war happened, we have moved. If you see the Sensex like 70, we have been 2,000 level, and then we have moved to 83, 84,000 level in a very quick successions. Like it's a movement of 15% in last 5 6 months. So not 5 6 months, 2 3 months kind of thing. So it has moved up in a euphoria phase. Now, whether it will sustain here, the results will actually tells us. Okay, so let's see what happened in equity market and what exactly you as an investor need to do for that. India underperformed global peers in CY 2025. Now, India underperformed global peers. So, if you see the India numbers and then with the China and all factors, India underperformed. But what we have seen in my global presentations across all parameters, India is well above them. Keep those points in mind when you see and correlate your decisions based on this. So globally, we have seen that India has performed well, but when it talks to the equity market, India has underperformed. Large cap outlook in India, large cap outperforms small and mid cap finally. So if you see the small cap, this is mid cap and this is a large cap. So finally, large cap outperforms small and mid cap. Why these two things has happened? Because uh, small and mid cap has aggressively moved up very high in the last 2 to 3 years. So as India. As a result, what happened? Because of the past data, which shows that India has moved up immensely, this has to be corrected. So when you see last 5 6 years data, then you will actually find out that things are normal. But when you see the small data, like 1 or 2 years kind of thing, India has moved up very rapidly, and that is the reason it has to come down, it has to neutralize. And that's thing in what happened in other data, this data what I'm talking about. Okay, so this is a YTD data, that's why in a second. But if you see this data for the last 5 years, India has moved up. India has outperformed other global peers. So similar thing happened with small and large cap index also. If you see the longer duration, like CY 2015 to CY 2025, Nifty index has outperform small cap. But if you see the smaller segment, like 2 to 3 years kind of thing, then you find the small and mid cap is outperform. So whenever you see the stocks or an investment or equity kind of thing, stretch a bit for a longer time. Now, if you analyzing a stock or a sector in 2 to 3 years, it has moved very high. If it has moved to very high and it is beyond its average return for the last 15 years, the predominantly it has to come down. That's actually happened. Snapshot of CY 2025. So this is the Nifty index. See, this is the price movement December 2024 to June 2025. So this is the price movement out here. Okay. Market cap to GDP is all-time high. This remain all-time high. So as the Indian profitability. Till the time we have a huge profit, no worry these numbers as of now. Now, when I say this average of 87%, I'm taking average from FY05. Okay, that's a 20 years average. Now, if you make an average of last 5 years, this 87% will be higher up here itself. So every data you analyze, you have to analyze data from those angle. Which data is taken, which time is taken, that has to be carefully selected. So this data, if you analyze for the last 20 years, obviously market cap GDP looks high. But if you look for the last 5 years, then it will not see much higher, because in the last 5 years, India's top line and bottom line has enormously increased. If the top line and bottom line increase, then this data looks okay. Okay. India's share to global market cap eases from September peak, but rebound in Feb from Feb 25 low. So that's the Indian share in a global market cap. So average is 2.8%. Again, if you see the last 5 years, the average this will push up here itself. So currently it is at 4% Indian share to global market cap. Now this data is interesting because if you see the US share to global market is 60% high. So US has covered a majority of the global market cap. Okay. So that's the data I'm saying. In India, the market cap and PAT both are on high. So if till the time profit after tax are consistently increasing for the last 5 years, that is why we say that the market cap and GDP has been a higher side. But if you see the last 5 years, you will not see the average is Average is much lower in that case. Average will be around 110 kind of thing. So that's what I'm saying. If the profit after tax is consistently increasing, so as don't worry about the market cap to GDP numbers being so lower as far as the average goes. Higher, sorry, as far as the average goes. Expect Nifty 50 index revenue to grow at 7% year on year in FY 2026. Expect Nifty index EBITDA to grow at 6%. So they are expecting EBITDA and this thing to grow at 7%. Now profit after tax to grow at 5%. Sectoral PAT growth for the quarter ended. So you see the telecom, oil and gas, cement. This is a sectoral profit after tax growth for the quarter ended June 2025. Now this is important because this will actually reflect in your stock price. Okay, so sector which has given much PAT will increase. Oil and gas PAT contribution show some signs of sequential increase in FY 2026. Indian Inc. share in GDP is at the highest since 2008. Um, so that's the data is showing that India's corporate share to GDP is highest since 2008. Okay, so this data out here, this data out there, listed company universe. So this data. Okay. Now this interesting data point. Now as for the valuations goes, Nifty 50 valuations average again. If you take last 17 years, 18.9. Now we have 21.7. But if you take last 5 years, the average is higher. Same thing happened with the small cap and mid cap also. If you see the last 20 years average, then large cap is at 15% premium, mid cap 19%, and small cap is at 52% premium. Now, now a lot of people are saying that small cap is trading at a 52% premium, but if the average is taken for the last 5 years, then the premium will not be like that. Because in the last 5 years, a lot of small cap companies have been listed in Indian stock market, and a lot of small cap companies have grown out outrightly. So it will continue to grow as we see more and more company getting listed in India. Okay, so outrightly rejected small cap because they are pretty because of 52% premium based on a long term average is wrong. So there are small cap whose valuations looks attractive, the company look attractive. And remind you, I told you initially also, despite US having so much of debts and all, if they keep on innovating, nothing will stop them. Similarly, if a small cap company has a unique product line in place which will impact people significantly, despite the sector having so much of premium, do not outright reject those companies. Okay, so that's my call on small cap. Valuations are above historical average. I told you, if you take a long stretch, it will higher, but if you take a smaller stretch, it will not be. Last 5 years is different from the last 20 years. So that most of the analysts do not understand that. So I take that don't go abruptly by the average of 30 years or 20 years kind of thing when you talk about the valuations. You have to take the duration and tenure in mind while deciding whether the the valuations are above average, in average, or in sync and kind of thing. Because in the last 5 years, PAT has moved considerably. Okay, considerably. 329% increase in profit after tax in last 5 years. So that has to be taken into consideration. DII monthly flow from equity continue to be robust. Domestic investor keep on investing. I told you in the very beginning, despite having so much of war and negativity, Indian investors keep on investing. FII flow, although had increased a little bit, but it has been down this year so far, but not that down which was used to have in 2024. FPI holding of Indian equity at decade low. So this now the foreign investors holding in Indian equity low, it's 16% mine. It's record low. Okay, so if you see the June 2012 data and now it's same. So this they will definitely come back once they see the US settle down a little bit and the tariff and all those things settle down a little bit. Now, if they come back, you can see the market reaching a new high again from there. Okay, so those investors who are thinking that India is at near about all-time high at 83,000 level at Sensex level, and whether they will enter or not, you need to see this data. Now, if this FY keep on coming, they will definitely go. And with all the numbers which I've shown earlier, looks very, very positive from my point of view in days to come. So don't wait for the very deep correction to happen. and there are stocks which are getting corrected. I know people are saying that the stocks are getting corrected, but don't. But one thing, like if a stock has given you 20, 30, 40% return in last, every year for the last 3, 4 years, do not expect that stock to give you the same kind of return in days to come. It has to correct. It has to correct. The rational analysis, I told you in a 2, 3 slides back, that profit after tax, EBITDA, expected nifty level, and expected to go at 7% level. So when your return is having 15% or 20% stock return, but the EBITDA is going at 7% level, somewhere or the other it has to correct. That is a nifty thing. Small and mid cap will definitely have a higher EBITDA percentage, like 12% and 15% kind of thing. But last 2, 3 years, you have seen a phenomenal growth in your stocks. That probably will not be there. Somewhere or the other, it has to get corrected for all the big companies. Okay, for the small cap companies, yes, I see a lot of potential out there, where you can continuously able to find those kind of return coming up. Okay, so it's depend upon how well those small cap companies are you investing into. Many stock have delivered return. Stock are trading at expensive valuations. I told you, stock are trading at expensive valuation because their stock price have moved way ahead in anticipation that they will get, good results. So to give you an example, like defense stock, if you see the defense stock in India post the India Pakistan war or during the war, uh, people have seen how Indian defense, materials have been used and successful. So they are in anticipation that this sector will actually outperform because lot of export will happen in Indian defense. People are praising the Indian defense material. So in anticipation that Indian defense material will have a huge demand, that all the defense stock are moved high. But the result of which will come 6 months or 1 year kind of thing. Now, anticipation and execution are two different things. Now there are a lot of time goes between expectation that Indian BrahMos and everything has performed extremely well, but when you execute, when the different countries execute, there can be a lag. There can be a delay in execution and all those things, which can reflect in the stock prices and the balance sheet, and hence stock prices. So that's what I'm saying. Initially, you can have a euphoria. You think that wow, this is going to happen, but in execution, sometimes it never happens 100%. So that is the reason stock correct. Okay, so that will happen when I say the stock at expensive valuations. If the execution happen well, then they meet the expectation that it's keep on increasing. But it doesn't happen, like in 100% cases, the execution don't happens accurately as we expect. Modern return expectation significantly. Now, this is an important data. This is an important data. See, Nifty 100 index, if you see the numbers out here, now this is the number. This is the number of a mid cap and small cap. Okay, this is the number. This is the number. So, if you are expecting somewhere around the return of this, is quite rational. Okay, like if you're expecting 12 to 15% return in days to come, which will be rational. Expecting a return of 20% plus in days to come will make you disappointed. Okay, so the reason why I told you in a couple of other slides earlier also, be ready for volatility. This is the normal thing. Geopolitical risk will always be there. Be it today, 10 years from now, 10 years before, everything is there. Trump, be it Biden, be it anyone else, they will come and have their own policy. India Pak tension will always be there. We have been seeing this India Pak tension since our birth, and I tell you, after our birth also we'll have this because of the thing which has been built on. I don't want to get into the political things, and earnings will always be volatile. So this volatility is a part of stock investment. That's the sooner one understand, and I am glad that most of the Indian investors understand that thing. Okay, so the COVID situation, the war situation, no trade barriers and all, and there's so many things happened in the last 20 years. It will going to happen more in the coming 20 years. So the volatility will always be there. Only thing is important is that how you react to those volatility. We have seen the people who have invested during all this volatility, they have gained. Only thing is that you have to invest in a company which are well managed, well governed, and well posed in all the situations. Okay, so then you don't have to worry about those things. Small spot time corrections, you never have to worry about those things. So moving on, promoter sold US $7 billion stake in FY. So promoters in India, we have been seeing that selling a lot of stocks out here. So decoding Jan, I just quickly move on. So what we are saying that overweight, get overweight in large cap, marginal weight in mid cap, and underweight in small cap. So that's what we are saying. So if you are investing right now, wanted to invest, look for the small cap which are innovative in nature. Okay, well governed, well managed companies. Else you go overweight in a large cap segment. Equity investment opportunity, well, I have already mentioned in my presentation itself. Debt market outlook, US inflation softened, still marginally above the Fed targets. Fed fund future pricing in two cuts till FY 2025. RBI measures since 2021 to support growth. Now, this is the RBI measure. They've cut it two times. I'm expecting other rate cuts happening, Sierra cut, all those things that RBI has taken over the period to support the growth. In a inflation within RBI target range, RBI active liquidity management keeps systematic liquidity in surplus. Values in the longer end of the curve. So just quickly move on. 1 year bond increase in JP Morgan index. So if you are looking for a debt investment opportunity, I will suggest you to invest in a dynamic bond kind of asset, uh, and go with a mutual fund route in a bond segment also, because because if there is a rate cut again happening, you will get advantage of the price movement itself. So if you are investing directly into the in the government bonds, you will not be able to liquidate it or getting out, getting in at time. So go with a dynamic bond segment of a mutual fund if you want to invest in fixed deposits kind of thing. In dynamic bond, you get all those corporate deposits and bond and government bond and everything, but they are well managed as far as the leverage goes. Okay, so a conservative investors who are looking for a fixed income kind of asset class, go with a dynamic bond kind of asset class, which will give you a better benefit as far as when we are expecting another rate cuts to happen. Gold investment, yes, everyone is talking about. I started saying that India, Russia, and China, they have been keep on buying golds like crazily anything. Okay, India gold reserve has picked up like anything, and that is the result we have seen last 2 3 years. Top performer in the gold. Okay, so this year has also been a gold performer. I am seeing the silver also is increasing. This is the gold data since 1960. You see the number, but despite saying that thing in 1980, we have the gold price here itself. It has not reached that. Even in 2010, the gold price has reached in this level, $2,500 levels. It has not reached that. So we expect, gold can reach here itself in $2,500 category. And that's why I'm saying that many of my investors have invested in the multi-asset kind of product while they have the gold exposure also. So I have been telling since inceptions of my presentation in last 3 4 years of my presentations that gold is a strategic investment, and every investor should have minimum 10% of their investment into gold. Okay, be it ETF, be it paper gold, anything. The gold has to be there as a class. So that's I still continue to say like that thing. And one important asset thing I just want to tell you today: uh, gold is the only asset which you own. There are no other asset class which you own. So you'll be surprised, no, sir, I have a property, I have buy shares, I have this thing, and no. No, you do not. You own a property where tomorrow government can come up with any clause or thing, they can take it away from you. It will not happen, obviously, but it can happen during a war situation, extreme situations. In stock also, it can go bankrupt and you gone. But gold, physical gold, is the only asset which you own. No one can take it from you. Well, that's a different topic altogether. But to mention here is that gold is a strategic asset class. Every investor should have minimum 10% of the gold of total investments. And with the thing happening across the globe with the Trump uh, crazy tariff policy and all those things happening and the US numbers and all the countries will keep on buying golds kind of thing. Record gold purchase by central bank. I told you earlier also. Now this is the thing: why gold pricing is total mine and total underground reserve. The very less underground reserve is there for the gold and total mine. So that is the reason, because the supply is limited. We have this gold coming up, and one interesting data I just tell you that there has been lab. There has been a lab which is actually trying to create gold. Okay, if you can Google it, you will find it. Lab generated golds. so which is there in different countries. Many research firms are doing it, but it is expensive. It is expensive. They are, since gold cannot be mined, so there are labs which are actually trying to create gold by this, but which is expensive. How this will survive, only time can only tell about those things. But anyway, silver is another asset class which you can look into, because silver has a huge usage apart, unlike golds, okay, in industrial and other factor. So silver, I expect, will continue to rise. Solar panel efficiency could shift the equation for silver demand, and silver is it is rare for silver to be traded above 36 ounce. So this is the data here. So that's what is about golds. A couple of more data points I've given here. India is the third largest rare earth reserves, but they remain largely unexploited. Okay, so this is the India kind, and India relies heavily in import of rare earth elements from China. Um, Obviously, this item will government will look into that. Since 1970s, a soft landing has occurred only thrice. Countries with highest forex reserve. Now, this is the data. Okay, very very interesting data. Countries with highest forex reserve. See the China, way ahead than any other country. Okay, so that is why people who think the Indian that China but China is big, big, big. This data itself tells you about that. China is selling treasuries and mortgage, rising crude price pressure on margin, central government gross debts. So that's the thing. FOMC summary economic projection, 10-year yields movement. So that's all from my side today. So thank you very much for listening to this. I have tried to accumulate as much data as possible for all of you, and days ahead are not negative, but I am extremely positive with all positive Indian news are happening. Only thing is that if you have expected, if you have seen, or if you have observed 20-30% plus return in equities in your asset class, do not expect that thing to keep on happening everlasting. So try to have some rationale behind that thing. And stocks, like any other asset, it do not give you like consistent 20%, 30% return kind of thing. There has to be like curves in that thing. So return around 15% is a very decent expectations. Anything more than that, although you are getting, you this has to be corrected somehow. That doesn't mean that you move out from the asset class totally and wait and then enter. Okay, so rational approach will be 15%, and stay in that. So nothing to worry from the India point of view. Stay invested, and whatever query you can have, you can get back to me for that. Thank you very much. We'll meet you up in August again with our monthly data. Thanks.